Welcome back to the Dividend Diplomats YouTube channel. Got your boys here, Lanny and Bert. The Dividend Diplomats. Big question for the community. Is this stock too cheap to ignore? It's about to get pummeled after it just released earnings. And guys, those results, not very good for this company, but it could create a great buying opportunity for us dividend investors.
Before we do, hit that subscribe button. Give us a nice thumbs up, guys. Again, stock too cheap to ignore, down 11% in the after hours. Filming this here September 19th, a Thursday night, guys. You might be watching Thursday Night Football, but we're recording Thursday night dividend stock videos. They are one of the same, baby.
That's right. S&P 500, the Dow, everybody is just shooting through the roof right now after the Fed cut basis points. It wasn't the 25 basis points that we were expecting. Oh, no, 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 no. Jerome Powell was like, we got a surprise for everybody. 50 basis points. We're ripping the Band-Aid off. Market took a hot minute to process it. It was actually flat the day of the announcement. Days after, phew, cha-ching, 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 that thing just kept on shooting up, and we are at record highs. That's what makes this one company so unique right now, and why we're saying it might be too cheap to ignore, because it might be the only dividend stock that's cheap right now to buy. So I'm very closely looking at this one to see, should I make a move and jump right in?
Yeah, I mean, Bert, let's just uncover the stock here. We're talking not UPS, not USPS, not DHL. We're talking FedEx, ticker symbol FDX.
Can't believe you dropped DHL in all of this, Lanny.
Hey,
All
thanks.
of them. Yeah.
Um,
You're like, give me the little moped driving around here. That's who we're going to be analyzing here today.
so, yeah,
What
I mean,
happened?
Bert, they came out with their earnings release here. Obviously, in baseball, we call this swinging and missing, baby.
Yeah, it was bad. They profit was down. It was adjusted profit, what they call it, was $3.60 was down from 4.55 a year ago, but it was $1.17 below consensus earnings. So it really badly missed earnings. Revenue was flat, which you'd think is fine, but it was still below below the estimates in the consensus guidance of what people were expecting. So they missed on the top line. They missed on the bottom line, and margin was down for Federal Express, one of its largest operating margin that accounts for 50% of its revenue. It was down to 5.4% versus 7.2% a year ago. So they're, I don't know if you're going to talk about fuel for their trucks, Laney. It looks like they pretty much ran out empty on the side of the road here for FedEx.
Yeah, you never want to see. There's one thing when if revenue fell, but when your margins are falling, costs are getting squeezed here because obviously revenue was unchanged, as Bert said, with over $21 billion. So
Mhm.
there's a lot of cost happening there, which is interesting. Now,
Bad news
what
did.
else did
Oh,
Yeah, go ahead. Go
I was
ahead.
going to say bad news didn't stop there, Chico. The bad news did not stop there. Not only
Lowering
did
guy.
they, yeah, the guidance was coming down. It was flying down that hill. Revenue is now expected to be single digit percentage growth, which was down from low to mid single digit percentage. So they're forecasting lighter revenue on the top. Earnings, their earnings per share, you'll see it in the paragraph we're going to put up here. They show earnings per share and then they adjust it for mark to market adjustments to pension. That's what all the sites base it off of. So we're picking that number. Earnings per share was at a range of $20 to $22. They lowered it to $20 to $21. So much like their actual results, they lowered the guidance on the top and bottom line as well.
Yep. And what is very common right now are cost cutting programs. You've seen all the layoffs, you've seen every company with their flagship brand cost efficiency name, and FedEx is no different. They're expecting a few $1 billion from their Drive program, a little over $2 billion. And what are they trying to do here? They're trying to be efficient. They're consolidating different subsidiary type companies or business units into just one overall organization. More than likely, that means reducing headcount, possibly reducing maybe platforms and systems, just trying to be more efficient. They've identified 4 billion of cost savings that'll occur in fiscal year 25. and their network 2.0 is what they're calling it. It's going to represent another 2 billion in cost savings in fiscal year 27. So they're all about cost cutting, which makes sense when your revenue is stagnant or you expect some growth, but yet your earnings are faltering. You got to figure out what the heck's going on in the middle. Time to cut out the fat.
Yeah, so we came into this video asking, is this too cheap to ignore? There's only one way to find out here. We're going to run them through the Dividend Diplomats Dividend Stock Screener, which features 3 metrics and a bonus metric: the price to earnings ratio, less than the S&P 500, payout ratio less than 60%, history of increasing dividends, and then that bonus metric, the dividend yield. Now, this one's going to be a little tricky here because we're filming this Thursday night. Earnings came out Thursday after the market. At the time we were filming this, it was down 11% in the after hours. FedEx was getting crushed in there. So when we were filming this, we grabbed some screenshots from Google Finance. It was at about 267.25. So for the sake of this screener, Lanny, we're just going to call the price $267 flat, probably about where it's going to open up and probably about where it's going to finish, assuming it hangs tight around down 11% on Friday when the market closes.
Yeah, I mean, I think it's a conservative way. You're using the lower end of the EPS guidance here, giving you a 13.35 PE. You know, pretty undervalued. I know UPS is probably also hanging around that number as well.
Now I'm on Seeking Alpha right now. Their 5-year average PE ratio is 14.38. So it's down even compared to its historical average, which is a nice little treat. When you're seeing lower earnings, when you're seeing guidance coming down, you always want to keep a close eye on that payout ratio to make sure that dividend is safe. Their annual dividend is $5.52. It's a payout ratio of 27.60%. And to me, this is what I like about FedEx compared to UPS. Very low payout ratio where UPS is closer to the 90 to 100% range. FedEx has a little bit more room to miss from an earnings perspective compared to their competitor.
Yeah. A lot more room.
Yeah.
Plenty of room.
I didn't want to be dramatic, but yeah, they have a lot of room. There's a big
safe dividend, guys. FedEx has a very safe dividend payout ratio. 5-year dividend growth rate is balmy at 15%. The one thing I did want to check while we are doing this video was, what was that last increase? Do you remember, Bert?
Well, we can pull it up right here.
Doing a quick A-Rod discount double check. It was 12 cents. Was it just under 10%?
Yes, it was $1.26 per quarter. And then in June, they announced a $1.38. So it increased 12 cents.
9.5% right there, guys, on the dividend increase recently. So below their 5-year average. They've been increasing it for a handful of years. Do we expect it to be 15% going forward? Probably not when you're lowering all this stuff. You probably would expect mid to upper single digits maybe over the next year as they figure out this drive program here for FedEx trying to save that dollars. But now, Bert, because the price has dropped 11% overnight, that yield goes up. But what did that yield go up to?
Over 2%. It's at 2.07%, which is above its 5-year average yield of 1.62%. So 45 basis points above its average.
Above the 5-year average, finally over that 2% Mendoza line, giving you some margin. Again, even though they're down 11% overnight, year to date, they're still actually up almost 6%. Again, over the last 5 years, they're still up almost 80% adjusted for that 11% decline. So this $65 billion by market cap company has a very safe payout ratio, a low PE ratio, a higher dividend yield compared to where they usually yield at. Is this stock too cheap to ignore? Is this a stock to buy right now? Bert, what's your hot take?
I mean, it's getting very close. I like it. It's hard to find companies that are for sale right now. It's below its average, great payout ratio. You see the FedEx trucks everywhere. Even though you look at the guidance, sure, they cut down the guidance, they're still going to earn over $20 per share. They're still going to grow their revenue. It's just not as much as everybody was expecting. And they don't have that massive cost increase the same way UPS does and the same way so many other companies do. And that payout ratio does have a lot of room in there. It's getting close, Lanny. I don't know if I want to be too stubborn with it and say 250, is the price where I'm going to really jump in. I'll at least in it grab 4 shares if it hits 250, probably where that PE drops to 12 and that yield jumps to 2.2%. So there's still some room to go, but below 250 per share is where I will probably say FedEx might be too cheap to ignore for me. What do you think?
All right, there it is. Well, I own over 100 shares of United Parcel Services, so I'm not adding to a new position now. So fun stock to watch. But what do you guys think, the viewers out there? Is this stock a stock to buy right now? What's your take on FedEx? Do you see them riding this ship here? Let
Mhm.
us know in the comments if you're buying the stock right
You
now.
know, oh, sorry, if you haven't already, subscribe to the channel. This video a thumbs up, and remember, you are either with us or you are against us, Jack.
That was Bert the Hurt and Lanny from the Dividend Diplomats. Over and out.